Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Now, we have a more exciting econ show. Things were a little light, but we're starting to get more data. We're starting to see where things are positioning as we go into the first 2 weeks of January, starting to open up kind of where things are going to close out for Q1 and what kind of positioning we expect. So we're going to break it up into our normal 5 segments. I know in the last one we had 4. So we're going to look at global rates and inflation drivers on a global basis. So when we look at rates, what is happening at the central banks? Why are they doing what they're doing? And really, how is inflation working into that? And are we seeing any slowing points? Because one of the things that we are seeing is the rate of change is slowing, and there's still inflation, there's still movement, because every country's kind of at a different point of where things sit right now. And then obviously we're going to also talk about food, because that is a huge driver to the inflation side of the equation. Then we're going to switch to leading indicators in the U.S. We're going to talk about inflation. The number came out, but how is that going to fade in Q1, and by how much? Because when you look at crude pricing, which then leads down to gasoline, diesel pricing, when you look at these underlying prices and where rent is and wages, there's going to be kind of this counter between where is sticky inflation, where is flexible inflation, how does it shake out? Because we think it'll fade in terms of the rate of change, but then really what comes next. Then we're going to look at job activity, because jobs, there's a very low unemployment. But when you look at, where are retirements? Because we saw a lot of people retiring, and really how does some of these different job factors in, and what do we see going on that front? Inflation was gaining steam in Asia, in Europe. And as we've been talking about, Europe is kind of a little bit behind us. So we think that there's more inflationary pressures there, with the economic data coming in fairly mixed in terms of some good, some bad. But where does that shake out? And then when we look at Asia, China really finished on a weak foot in 2021, and really what does that mean for 2022? Have we seen any stimulus? Do we see any stimulus coming through? Where are some of these defaults coming from? Because again, we still continue to see a lot of overhang in the Chinese theater. So before we kick off some of this, we just wanted to look at going nuclear, and I mean, we could do a show just on nuclear in general, and it's a very divisive term, because some people are adamant we need nuclear for the future. Others don't even talk about it because it's never going to work. So this is where you get an idea of what is being proposed, what is being planned, and Asia continues to be the big driver of where nuclear capacity is being built out, with a lot of it obviously being in China. We had a thorium reactor turn on. It's going to be very interesting to see how does that work out, where does that go. Europe, in terms of what's in construction, what's planned, we have some shutdowns increasing for Germany, but then you have some proposed, but really nothing being built in a lot of these other areas. And North America is going to be the big one, obviously the U.S., to see does nuclear get traction? Do we start to see some adoption of, if we really want to get serious on this green transition, this net zero, is it possible without nuclear? I don't believe it is, and this is just saying, based on the current technology, based on where things are, nuclear is a big part of our future. But again, that can be left up to debate. It's just interesting to see the backdrops. So now when we look at central bank asset purchases, and the reason why you might think why are you talking about nuclear randomly, and now you're jumping into central bank asset purchases? And the reason why I bring it up is because inflation. When you look at inflation, when you look at how inflation is being designated and broken out, and how energy is such a huge component to it, electricity, heating of homes, all of these pieces become so important, and we have to address what is our base load electricity capacity going to look like for the next 70 years. And how are we going to create not only efficiency and something environmentally friendly, but also redundant, also something that is affordable and can help essentially drive economic growth. So when you start looking at these purchases and what has been done at some of these levels, you get an idea of how they've differed. So asset purchase programs in emerging markets differ in scope, size, and duration versus advanced, obviously, because they don't have the same bandwidth as that we do in Japan, Europe, US, United Kingdom. So when you look at sovereign secondary markets, where things sit, the ABS covered bonds, that's where you can see the amount of time they've been purchased, which is now nearing over 16 months for many, where a lot of the other areas, Turkey, Ghana, Indonesia, it started to slow after about 6 months due to, it's just, they don't physically have the runway that we do. And that's why emerging market pressure still continues to be a focal point of how we see the year playing out. Now, when you look at milder inflation, so slower increases for food and energy prices have kept consumer inflation lower in Asia compared with other regions. Now, that played out again in China, and we'll talk about that in segment 5. But this is one of those key things. But as energy remains elevated, that's still, even though inflation is milder, it doesn't mean it's coming down. It doesn't mean you're going to get deflation. It just means the rate of change hasn't been to the same level. And at the same time, Asia is essentially the starting point for inflation, especially thinking from a Western perspective, where we're importing a lot of these semi-finished and finished goods, and then that's the starting point. So they've seen inflation, but then there's inflation on top of that. There's day rates, there's shipping rates, there's insurance rates, then there's port fees, and then there's getting it from the port to my warehouse. Then there's labor and wages and doing that, and diesel costs. So every person, every hand adds money. And when you're looking at the fact that we're importing so much, that is why we have those levels at such an elevated component. As the U.S. December budget deficit came out at $21.3 billion versus the estimate of $5 billion. So the U.S. is in good position. So now when we look at the number of central banks hiking minus easing, you get an idea of just the net hiking aspect. As we keep talking about being in a rate rising cycle, this is what it looks like. This is that slowdown that we keep alluding to, and the pressure, because you're getting rate rising into a slowing economy, which again leads to underlying problems. And the macro man, if you will, on Bloomberg, I think he had a really good piece talking about how rate rises end up leading into recession, but what happens when you're looking at some of the deviation that we're already seeing in GDP growth and just global growth, and what that is going to do when you layer on not only quantitative tightening, but also rate rises. And this is when we start looking at some of the headwinds. So emerging markets, when you look at the economic surprise index, continues to be negative. Emerging markets surprising to the downside, which is going to continue to pull down EPS. Policy rate continues to get tighter, continues to not be accommodative, which is going to pull down. And this is the pressure we keep talking about, especially when we're looking at equities and debt, and some of those pressure points that remain in the EM space. And that's the underlying dilemma for emerging market central banks. You have economic surprises really down to flat, but inflation surprises are exploding higher. So you don't want to raise rates to push yourself into a recession, because you want to be somewhat accommodative, but you also can't let inflation run rampant, because once it goes, people lose confidence in that country, and especially that country's fiat, then all is lost, as we've seen in countless times, most recently from the Asian currency crisis, and the same in the Latin American currency crisis. So these are the things that they're trying to balance, which is why raise rates, start that process, try to ensure that there's enough currency available. As I was saying previously, the US dollar had that support. I had no positions since 96. Now it's back down to just below 95. this is where they're trying to manage it against the dollar. They're trying to manage to make sure that there's some protection when you're looking at it on an inflation standpoint. While on the OECD side, you can see that total food that inflation is at highs. And that when you're looking at totals, U.S. OECD total is above when you're looking at everything in general, and you can see that it's at these elevated levels, which is why we do think that you're going to get an acceleration of rate rising and other types of cuts on the inflation to bring some of this inflation under control. Then when we look at the Bloomberg, the negative yielding debt, you can see that there is less and less negative yielding debt. People are demanding a higher rate. You're starting to see some of this come back through, especially as there's more concern. People are going to shift, in theory, out of equities into debt. But at the same time, you're going to have central banks ending their quantitative easing, going into quantitative tightening, which will then naturally force rates up just because you're taking away your biggest buyer, which was the central bank. And now they were buying really with abandon because they didn't really care because they had a target to hit. But a consumer doesn't have to. So they're going to be more strategic, which is going to continue to draw down some of this negative debt. But when we look at the inflation front, you can see that that rates have shifted back up when you're looking at Shanghai Shipping Exchange. And then when you look at the freight index, you can see that we're really starting off the year back at all-time highs. And that's when, especially when you layer in what the cash freight index looks like on the U.S. front, because this also, like that number also gets married to, well, what does it cost to move it within the U.S.? So the expenditures component of the cash freight index, which measures the total amount spent on freight, rose to another new record level of 4.419, up 44% year on year in December and 3.4% month on month. On a seasonally adjusted basis, expenditures were literally off the charts. I love the way that they write, and I highly recommend signing up for the newsletter. Rising 6.6% month on month in December, with a slightly larger contribution from higher volumes and to a lesser degree, higher rates. On a 2-year stacked basis, the expenditures component at the cash freight index was up 62% in December, with shipments up 15% and rates up 41%. And then when you look at expenditures, this is just showing you how high those expenditures actually went and what that leads us into for 2022. And then when you look at the inferred freight rates and just how elevated and how really up and to the right this is really pushing. So when you start looking at those shipments, the cost, and how that continues to stack on itself, well, you also have extreme weather events, which also increases, droughts, snowstorms, floods, which then impact how quickly you can move goods. I know people in the U.S. are taking pictures of empty food stores. Well, there's been a lot of issues getting that food from point A to point B, and that's leading to a lot of these shortages because a lot of the trucks have been hung up and unable to replenish. Now, those are things that can be fixed quickly, especially as roads clear. You had some shutdowns, but it's getting extreme. And this is not a science, talking about, is there climate change? Is there not climate change? We're just looking at weather patterns. And weather patterns historically if we go through history, weather patterns shift. They're alive and well and move around. So as things continue to impact, we are seeing these shifts. So these extreme weather events are creating some of the additional problems when we look at droughts, which have hit massively into what could be the yield coming from Latin America. Now, it's happening in January. January is a bad month for this to happen, but it's not as bad as February. February and really the first week of March are pivotal for soybeans in Latin America. So if we get this drought and this extreme heat going into February, then there's really no way to make this up. Now, we've already seen impacts because we're going into germination. We're not seeing the same type of uptake. So we're already starting out at a reduced level, as we talked about last week. But as that continues to hit, it just means that the yields going to get worse, and there's not going to be enough time to make up, and that's going to hit again in 2022's harvest that will create these additional shortfalls and keep food prices elevated. And that's when you look at South America, you had severe frost, now you have severe heat. Europe, you had major flooding, then you had major frost. North America, you had a heat wave in Canada, now you have some massive frost coming through, and you're seeing a lot of these shifts. Now, looking at that in general, so dry conditions snapped the run of soy crop records in in Brazil. So now we were supposed to be above in 21-22. Now we're actually at about 138 metric tons instead of being at about 158. So then when you look at fresh records, this is why the more bad weather for the world's oilseed growers in terms of rapeseed and canola. This is the food inflation side. So futures have been on a tear. Canada, Europe were plagued by scorching droughts and planting cutbacks, cutting global rapeseed stockpiles to a 4-year low. Now worries are mounting about supplies of rival vegetable oils, with hot and dry weather hurting South American soybeans and then flooding hitting palm oil farms in Malaysia, all of which, again, leads to why we think that vegetable oils and food is going to continue to be a tailwind for where this inflation is going to shake out. Then when you look at inflation in rich countries, hits a 25-year high, as we had shown previously, and the pressure is going to remain. Then when you look at so looking at some of these different pieces, so strong order growth and rising backlogs does bode well for relative EPS. So it comes down to margin though. So some of the manufacturing new orders are coming down. We've had some of these backlogs, some of the unfilled orders. As some of the backlogs clear, as some of the inventories pick back up, you're going to be able to see a little bit of this catch up, which will be a tailwind for some of the negative that we've talked about on the U.S. economy front, and will also help support some of the new imports from Asia, which will help also some of the emerging markets. So it's not just all bleak. It's a matter of this is a bit lumpier, and that's why it's going to be tough to know when exactly it hits. It could be, February, it could be April. This is one of the reasons why we think it's more of a March-April event where you start to see some of this benefit. Now, meat continues to rise. Beef prices rise to the highest since August. And this is something that we think is going to continue to drift higher and it's not going to go to the highs of August that we saw, but we think that we're really back on our way to 300 on this scale, that 300 level. So companies hauled in over $12 trillion in financial markets in 2021. Well, why not? There's hot money sloshing around, so go out and get it. So a lot of companies did just that. So now the question is going to be, how is the leverage? Where does the balance sheet sit? And that's where you're going to start to see some of this differentiating factors in 2022 and beyond. So when you look at the U.S. City Economic Surprise Index, you can see that we're still positive, but fallen back to the low end as some of the economic surprises have underwhelmed because, again, estimates got really excited and now they're continuing to miss. So we still think that there's going to be some of this rehashing lower. And then when you start looking at, even if Congress passes fiscal legislation, it won't change the fiscal retrenchment underway. And this is why we continue to see that fiscal and monetary headwinds as we go forward, because this is something that we think is going to eat into retail sales, savings, and real wages, and what that spending is going to look like over the next few months, and really the next year or so, which is going to be a much bigger problem.